So this presentation today is about, is moving your property portfolio, which is held in your personal names, the correct thing to do, okay? It's not right for everybody, it is right for some people, okay? So in the seminar, we're going to do set the scene a little bit. Why are people looking to do this? We'll go over that very briefly. What are the potential tax savings available by moving your portfolio over to a limited company? We're not going to go into numbers in detail because it's 3:30 in the afternoon and you'll just glaze over if I show you a PowerPoint full of numbers and calculations. Then we'll talk about the 3 potential issues on moving a portfolio over to a limited company, and then a couple of other points of note, and we'll have questions at the end if that's okay. So, to set the scene, why are people moving their property portfolio into a limited company? The main driver over the past 5 or 6 years has been Section 24, okay? Not getting a full deduction for your mortgage interest payments, okay? So if you look at the left-hand column there, that is the 2016-17 tax year, when it was the last year to be normal as a property investor for taxation purposes. You had your rental income, you could deduct your interest payments and your other expenses. In this example, a 35 grand profit would all be taxed at the basic rate of 20% to give a tax liability of £7,000. Roll forward to the tax year that ended in April 2021, and is still the case now as well. Same example, rental income of 100 grand, but you do not get a deduction for the interest at this point. You do get a deduction for your other expenses, which means your profit is a fictional profit and inflated. Some is still taxed at 20% in this example, some at 40%, and you get a 20% credit, so 8 grand credit on 40 grand of interest, 20%, to reduce your liability, okay? But this example highlights that because of Section 24 and not getting the deduction for interest, it pushes people into the higher rates of tax, or it can do, and as a result, tax liabilities could increase by 20% of the mortgage interest payments, and it could even be more if you start to lose child benefit or start to lose your personal allowance and so on. So it can be quite dramatic, okay? The impact Section 24 has had as well over the past few years has been significant for a lot of people, but now with interest rates increasing as well, if people are highly leveraged, you know, interest rates are going through the roof compared to where they were historically, that will only kind of exaggerate the effects of Section 24. So a lot of people who kind of sat on the fence for the past 5 years in terms of not looking to restructure because they were not too badly affected by Section 24 are now starting to look at it. So, first of all, the main thing to consider when asking the question, should you move your portfolio to a limited company, is are you going to make tax savings by moving the properties over to the limited company, okay? If you stay with the properties in your personal name, as we touched on in the example, you're paying tax on a fictional, inflated profit because you're not getting a deduction for your mortgage interest payments, potentially being taxed at 40 or 45%, and possibly 60% when you start losing your personal allowance and child benefit, okay? If you roll that forward to trading as a limited company, then the company is taxed on the genuine profit, so rental income minus all expenses including interest. The company will then be taxed at 19% currently, but depending on the level of your profits, it may go up to somewhere up to 25% come 1st of April 2023. Now the other thing to note as well is when other people say there's a double tax charge when you trade as a limited company, they're absolutely correct for most people, because most people are extracting the profits to live off, and there is an income tax charge when you extract money from a limited company. It will either be at the basic rate, 20% and 40%, or at dividend rates, which are currently are going to be 8.75% or 33.75%. However, as I just gave the example to the lady just now, a married couple could still draw out 100 grand of income from a limited company every tax year. And if they have no other income, they can take 12.5 grand of salary, 37.5 grand of dividend, and the way the tax rates work at 0% and 8.75%, they'll pay an effective rate of just 6% on extracting £100,000 from a company, okay? So you've got to run these numbers based on your actual profit levels, your level of interest, and what you need to draw out from your company every year. And you do two calculations, one, staying as you are, and the other one, limited company taxation on genuine profits, in addition to income tax on the extraction of the profits, okay? But now, assuming there are significant enough savings to make moving your portfolio to a limited company viable or beneficial, there are three potential issues when you move property from personal names to limited company, okay? And they are capital gains tax, stamp duty, and possibly having to refinance the portfolio, okay? So we'll talk about each one and how they're dealt with. Capital gains tax. When you move property from your personal name to your connected limited company, and the limited company would be connected to you, okay? Everything takes place at market value, okay? So if you were moving your properties over to a company today, you'd say, right, what is the current market value of my portfolio? Okay, and that's one figure. And then you'd say, what is the base cost of these properties for tax purposes? How much did I pay for them? And how much have I spent on capital refurbishment since I've owned the properties? And you deduct that figure from the current market value. What you've got left there is your capital gain, okay? And potentially, that capital gain would be taxed at 28%, okay? And that gain does crystallise, but you can relieve it through something called Section 162 incorporation relief, okay? Now, to qualify for incorporation relief, there's three criteria that need to be met. You need to transfer all the assets of a business, which we'd make sure you do by telling you we've got to move all the assets of the portfolio, so all the properties in there. You have to do the transfer in exchange for shares in a limited company. And the main one is that what you're transferring qualifies as a business, okay? And there was a court case about this in 2013, quite a famous one that's kind of opened the doors for landlords to be able to incorporate their portfolio. And it's called Elizabeth Moyne Ramsey versus HMRC. And basically, Mrs. Ramsey was a relatively small Northern Irish landlady. And I think it was way back in 2004, she moved her property portfolio into a limited company. Her accountant claimed Section 162 incorporation relief, which has been around for 30 years now. And it went to court. HMRC won the first case. It got appealed up to the upper tier tribunal, and the taxpayer won, okay? So it's opened the doors to show that if you qualify as a business, and property investing can be a business, HMRC were arguing that it effectively could not be a business, but the case proved it can be a business, and if so, you can move your portfolio to a limited company and fully mitigate the capital gains tax by claiming incorporation relief. Now, the Ramsey case highlighted 4 key areas that kind of highlight whether or not your property activity qualifies as a business, okay? And there's a little table on there. So if your turnover is more than 20k, if you've got more than 4 properties and spending more than 10 hours a week on average on your property business, and ideally with houses, if you meet all 4 of those criteria, you are almost certainly a business and therefore can utilise the capital gains tax relief to move your properties to a company and pay no capital gains tax, okay? Now, these 4 criteria, in my opinion, they're not all weighted equally. The main one, and from my conversations with HMRC, the main criteria is the number of hours spent on the portfolio, okay? In the Ramsey case, Mrs. Ramsey argued she was very hands-on with the properties, and it gave a list of all different things she was doing, like even cleaning the staircase and mowing the lawn and so on. She was claiming to be spending 20 hours per week on the property business, but it is kind of recognise that anywhere north of 10 hours per week on the property business on average is sufficient to be classed as a business, okay? And the technical wording behind it is activity in connection with the letting of property. So again, that's very broad. You guys here are attending this event today, and this is in connection with letting of property because you're hopefully coming here to learn, you know, and keep yourself up to date with the different changes in regulations and, you know, different things going on in the market. But it's also, you know, dealing with letting agents, dealing with dealing with brokers and accountants and tenants. So like I say, the main one here is those 10 hours per week. And if you've got more than 5 properties and you've got a decent turnover, then it's all very useful to kind of show you're a business and can take use of incorporation relief. I'll touch on it now as well. The main reason we're talking about people moving the properties to a company is to get full deduction for the mortgage interest payments and to overall create a tax saving. However, the way that incorporation relief works, when the company acquires the properties, they're deemed to acquire them at today's market value, okay? So then if the company acquires them today, but then sells one of the properties, say, in a couple of months' time, and the property prices have remained stable for those 2 months, the company's corporation tax computation in relation to that property disposal will show sale proceeds, so however much it sold the property for to a complete third party, minus the market value of the property 2 months earlier, which will be the same figure, which means there will be no gain and therefore no tax to pay on that disposal. Now the thing to say there is that money then is not in your back pocket as an investor, it's in the limited company's bank account. Now, if you were to go and reinvest those proceeds, say into better performing properties hopefully, then there would be no tax to pay on that reinvestment other than the normal stamp duty on buying a property. And you've saved yourself potentially a lot of capital gains tax there if big gains have accrued on that property from when you bought it originally to when you moved it into the company. So that is another reason why people are doing the incorporation planning, and it can result in some quite good tax savings. Now, I did this presentation a few weeks ago and somebody said, that sounds too good to be true. What about those gains that have built up from when you bought it originally to when you move it into a company? Now, they don't just disappear into thin air. What actually happens to those gains is they attach themselves to the shares you now have in the company. Do you know what I said earlier, you have to do it in exchange for shares in a company? Well, those gains kind of staple themselves to those shares, if that's a good analogy. But they would only come back to bite if you sold the shares in that company to somebody outside of your family. Now, if you never do that, those gains will either die with you if you die owning those shares, or you can mitigate it if you end up doing inheritance tax planning by moving the shares to the next generation. So it is a good bit of planning if you are thinking of selling some properties that have got large capital gains on. And that's just a slide giving the example I've talked about there of a company selling a property shortly after incorporation. There's a summary of the benefits of the capital gains tax on incorporation, which I won't repeat. So then, if you want the slides, by the way, drop me an email after the event and I'll send them to you gladly. The second issue we talked about was stamp duty land tax. I'll add at this point, if you've got property in Wales or Scotland where the rules are, well, either land transaction tax or LBTT, everything I say now will apply to those properties as well. But if you are a single person and you move property from your personal name to a limited company, again, market value rules apply because it's a connected transaction, and Section 59 of Finance Act 2003 means stamp duty would be due on the full market value of your portfolio when you move it over to a limited company. So that would undoubtedly put people off moving the portfolio to a limited company, okay? But the rules are different when a partnership transfers property to a connected limited company. Why is that the case? The real reason is because there's some rules in Schedule 15 of Finance Act 2003 that are very favourable to partnerships. Now, when this legislation was brought in, a lot of doctors and dentists were trading in their sole name, but I think some rules were changed and it allowed them in the early 2000s to be able to trade as limited companies. Doctors and dentists also normally own the building from which they trade from. So, but for these rules, they would have had to pay stamp duty on moving their practice to a limited company. So these rules, I believe, were brought in mainly for those purposes, but it's been around for almost 20 years now. HMRC know property investors are using these rules to their advantage. They've had plenty of time to close or tailor the legislation. It's recognised in HMRC manuals, and in a nutshell, I believe the rules are just unfairly, some people would say, more beneficial to partnerships than they are to single people, okay? And just to be absolutely crystal clear, we normally deal with married couples, so as long as the married couples, the husband and wife, are entitled to the rental income of the properties before the incorporation, and afterwards, through their shareholding in the limited company, they're still entitled indirectly to the rental profits, there will be effectively no change of ownership and no stamp duty to pay on that. So then the question becomes, are you a partnership? Now, what is a general partnership? Comes from the Partnership Act 1890, and it is a relationship that subsists between two or more people carrying on a business with a view of a profit. And like I say, most of the stuff that we do is aimed at husband and wife couples. They're clearly two people. They're normally doing it to make money. They're doing it with a view of a profit. So then the only question is, are you carrying on a business? And this circles back to what we were talking about before about the capital gains tax. If you're spending 10 hours a week on average on activity in connection with the letting of property, then you're likely carrying on a business. And if you meet the other bullet points as well, you probably are a general partnership as well. Now, what people usually think at this point is, well, we've never submitted a partnership tax return before, so we can't be a partnership. Now, going back to HMRC's manuals, which are aimed at their own staff, there's a couple of things to say. The first thing is that it says a partnership commences when there is an oral agreement between the partners. A subsequent partnership agreement that's written down is irrelevant, okay? So as long as the husband and wife talked to each other when they bought the properties originally, there was an oral agreement, and therefore the partnership has probably been ongoing for many years. Also in HMRC's own guidance, it says it's very difficult for a HMRC inspector to be able to challenge a husband and wife partnership. And it's not necessary for partnership tax returns to formalise a partnership because they're almost self-serving documents, okay? So that is what we're saying on partnerships there, that's general partnerships. A limited liability partnership forms this kind of structure. And what we just talked then on general partnerships, like I say, was mainly aimed at husband and wives. If you're a single person who wants to move into a limited company, you can use this structure almost like a stepping stone, okay? So the individual investor is one partner in the LLP, the Limited Liability Partnership. The individual forms a NewCo, which is the other partner or member of the LLP. And if that structure is run for a period of time, say 2 or 3 years, then after that period, you can move the portfolio into a limited company and take advantage of the same stamp duty rules that we were talking about earlier. Okay. So they're the two taxation issues with incorporating a property portfolio. The next one is mortgages, okay? Now, if you had to refinance your full portfolio as part of moving it to a limited company with early repayment charges, arrangement fees, increased interest rates through trading the limited company, a lot of the benefits would probably be wiped out as a result, okay? But what can be done is you can just move what's known as a beneficial ownership of the properties to the limited company, And in the vast majority of cases, that removes the need to refinance the properties on moving them to a limited company, okay? So every property in the UK has what's known as a legal owner of property and a beneficial owner, okay? The legal owner is the person whose name is on the mortgage and whose name is at land registry. The beneficial owner is a person entitled to the rent and therefore taxed on the profit, okay? So at the moment, if you're 100% legal owner, you're probably 100% beneficial owner as well. But one of the most common bits of tax planning there is where you've got a husband and wife, they buy an investment property jointly, and that means the first day that they buy the property, they are also 50-50 beneficial owners, okay? If the husband's a high rate taxpayer and the wife's at home with the baby and got zero income, she's a zero rate taxpayer. The most common piece of tax planning is to move the husband's 50% beneficial ownership to the wife. So then the husband is a 0% beneficial owner and the wife is a 100% beneficial owner, okay? There is no need when you do that to refinance the property or even to notify the lender, okay? Now, when I say move the beneficial ownership of these properties to a limited company, it's exactly the same principle as the husband moving his 50% beneficial ownership to the wife, okay? This concept of beneficial ownership, again, going back to HMRC's manuals, goes back to medieval times. It's a well-trodden path. The stuff I've talked about there on terms of the husband moving it to the wife, HMRC has its own form, Form 17, to be able to allow people to do this. But key to all this is you have to check the mortgage terms and conditions to ensure there is no clause in there that prohibits you from being able to do this, okay? Now, we've looked at the T's and C's, and legal people have looked at the T's and C's of investors who've got these mortgages, and very few lenders have a clause that says you are not allowed to do this. And the legal advice we've had is that unless it is carefully circumscribed or stated, categorically in the T's and C's, lenders cannot stop you from doing this, and therefore you are able to do this, okay? Now, over the past 6 months, and by the way, we've been doing these incorporations for well over 5 years now. Sometimes it means they've got to move the legal ownership to the limited company before they complete on a refinance and get onto a new fixed term. All that's doable with no tax charges. You just need to go to a solicitor and maybe work with a tax advisor that understands the process. But people are able to refinance the properties after they've done this planning, and for some time they're getting the best of both worlds in terms of they are paying taxation under the limited company, which will create savings overall, and paying personal buy-to-let rates on the mortgages while the profits are being taxed in the company. And that is effectively how it's done. So there's the overall benefits of the incorporation. So like I say, you can get the properties in there with no capital gains tax or stamp duty. The historic gains are washed out and effectively exempted, but not 100% exempted. Property values rebased, can mean lower gains on future disposals, lower rates of corporation tax, full deduction for your mortgage interest relief, and potentially no need to refinance. Yeah, and then just a few other points of note to kind of put a bit of meat on the bone. Incorporation is not a new thing. Until October 2017, you could actually write to HMRC before you did the incorporation with your full facts, and they would either turn around and say, yep, we agree that you get the stamp duty and CGT provisions that we talked about earlier, or they turn around and say, we're not saying yes. They wouldn't say no, but they also wouldn't say yes. But because so many people have done the incorporation, they didn't have the manpower to respond within 28 days that they have to on what's called non-statutory clearance applications. I would say between 2017 and 2020, thousands of people incorporated their property portfolios. Like I say, we've done over 200 ourselves. We've only had 3 inquiries on those incorporations. The reason being, we only do it where we believe the investors qualify. We've had 1 closure notice on a very small portfolio that claimed incorporation relief, and we've got 2 ongoing at the moment. and the questions HMRC are asking are, well, the two people are one's a doctor, one's a dentist. They're still practicing in those professions. So the questions HMRC are asking is, how can you spend and earn so much money being a doctor or dentist and have all these properties and still spend 10 hours a week on the property business? We're just having that back and forth with them at the moment. And then the final thing I want to say is, if you are a single person that's not in a general partnership, and you might have to pay stamp duty if you want to move them to a limited company, if some of your portfolio is commercial property and it's not 100% residential, we could potentially bring the stamp duty down to 1%. That might make it a bit more palatable in the short term. Okay? There's a bit about myself. I'm a chartered tax advisor. These other advisors here today who are not qualified. I've got 14 years experience. We only deal with landlords and we give objective advice. You know, we're giving advice to, you know, what's right for you, not what's right for our own back pocket. And we work with people's accountants. We're not interested in becoming your accountant that you see every year. We just give you very specialist advice on specialist areas of taxation. Okay, so we've got about 4 minutes left. There's my contact details if anybody wants them. Like I say, if you want the slides, drop me an email after the seminar. Has anybody got any questions while we've still got a couple of minutes?
There's one called out latent gains.
Yeah.
A little gist on it, but I don't fully understand it.
Yeah, so the gentleman's asked about latent gains. I'm going to put a bit more meat on the bone now, so it's a good question. To qualify for incorporation relief, you have to give the 10 hours and so on. Another requirement is that the capital gain that you're relieving is smaller than the equity in your portfolio. Okay? So the equity being current market value less outstanding borrowing, that amount has to be bigger than the capital gain so that the gain can be absorbed by the shares. So if you're thinking incorporation looks good, we'd ask you for some information up front that kind of highlights whether or not the latent gain is actually an issue for you.
How much for that consultation?
Nothing. That's free of charge. Okay. Any other questions? Yes, sir? Yeah, good question. How do you determine market value when you do this? The market value of a property, you only really know when you're selling a property to a complete third party, okay? So then what I would say is the market value of a property is not one figure, it's normally a range, okay? You might say it's somewhere between 190 and 210k, okay? For the purposes of what we're doing here, moving it to a limited company, if you can fully relieve the capital gain that you create on incorporation, I'd be inclined to say use the higher end of that valuation, because then future gains would be lower and lower tax in the company. But it's all self-assessment, and you have to be able to provide HMRC with good reasoning as to why you've used that figure when you come to use it. Okay. Any other questions? Yep.
Do you have to when you do this kind of exercise of call it transferring to the company, do you have to do the whole portfolio at the same time, or one at a time, or how does it work?
Yeah, good question. So do you have to move all the portfolio at the same time when you do this? To get the capital gains tax relief, yes, you do. You have to move all of it in one go, because you have to move all the assets of a business. Now, if the only way I'd say you don't do it all in one go is if your properties are not at a capital gain. So if they've either remained stable over the past 10 years, let's say they're in the northeast or something, or they've gone down in value, or you've only just recently acquired them, then if capital gains isn't an issue, you could do it piecemeal. Or if you've only got small gains, less than say 10 or 20 grand on each property, you could maybe do one a tax year to use your annual exemption, 12 grand for a single person, 25 grand for a married couple. But yeah, that's it basically. Okay, that's all the time we've got. So thanks for your questions. I'll hang about for a few minutes. But thanks very much.